this module, you will learn about meaning and definition of cash conversion cycle, cash conversion cycle period, cash conversion cycle for trading and manufacturing operations, gross and net working capitals. Introduction. We know that every business needs raw materials to produce goods. During production, other expenses like salaries and wages for labor, insurance, and utility bills also get added. When the finished product is ready, it is sold to a customer. If it is a cash sale, the sale proceeds are realized immediately. If it is a credit sale, then it is realized after the credit period is over. The time period between buying the raw materials and realizing cash from the customer after a sale is known as cash conversion cycle, CCC, or an operating cycle. Definition of cash conversion cycle. Cash conversion cycle, or CCC, is the time required for a business to convert its raw material into revenue from sales. It is the amount of time required for the business to receive cash from the sales of finished goods produced from the raw materials bought in the first place. CCC can also be understood as the number of days where the cash is held up in the operations of a business. Cash conversion cycle period. CCC depends on the product being made and sold and hence is not the same for every product. Some products have a longer conversion period and consequently a longer operating cycle. In some cases, the conversion duration is less. It is less, especially in a trading business where it does not involve the actual production of goods. Remember, the longer the cycle, more is the need for working capital, whereas shorter CCC means less working capital is required. CCC for a trading operation. The CCC for a trading operation is different from the CCC of a manufacturing unit. Let us have a quick look at the CCC of a trading unit. A trading business does not deal with the actual production of goods and services. The conversion cycle for a trading unit initiates from a stock of goods. Working capital is needed to buy stock. Once the stock is sold to the customer, it takes some time for the cash from sales to come. The stock is sold to the customer as sales, which in turn become debtors for the payment due, and finally, cash is received from the debtors. This is a very simple conversion cycle. In the real world, there could be many sub-stages in it. CCC for manufacturing operations. Cash conversion cycle for a manufacturing unit is the extended version of trading cycle. It starts with the purchase of stocks of raw material, which is then sent for production and becomes work in progress. Work in progress is then sent for finishing and becomes stock of finished goods which are sold to a customer who becomes debtor for the amount due. The cycle closes when cash is received from the debtors. Again, this is a very basic cycle. There could be sub-stages due to operating expenses, bad debts, wastage of material, defects in manufacturing, etc. Gross working capital. Gross working capital is also known as current capital or circulating capital. It is the total of all the current assets of a business which can be converted into cash in short time or short conversion cycle. The examples of current assets are cash, inventory of raw materials, work in progress, finished goods, spares, etc. It also includes amount receivables and trade debts. Current assets and current liabilities. As mentioned before, current assets include items that can be converted into cash in a short time. Current liabilities are the amount payable that are expected to become due for payment within a short period, say 1 year. They are payment due to vendors and service providers, salaries and wages to employees, short-term borrowings, and provisions. Following are some current assets and current liabilities. Current assets include stocks, debtors, cash, short-term investment. Current liabilities include outstanding expenses, creditors, short-term loans. Net working capital. Net working capital is calculated by balancing the current assets against the current liabilities. To calculate net working capital, deduct all the current liabilities such as customer deposits, accounts payable, interest payable, short-term loans, taxes, maturities of long-term debts, and any other liabilities due within a year from current assets. Current assets are cash, short-term investment, accounts receivable, inventory, etc. Net working capital is more accurate in nature and gives a complete picture of business's liquidity. Let us take an example to understand it better. Gross working capital versus net working capital. Let us take a look at an example of a company, ABC Limited, that has the following current assets and liabilities at the end of the financial year. Here, the gross working capital is the total of all the current assets, that is 2,10,000. The net working capital will be rupees 40,000. That's the difference between current assets of 2,10,000 Indian rupees against total current liabilities of 1,70,000 Indian rupees. In this module, you have learnt cash conversion cycle or CCC is the time taken to convert the raw materials in cash through sales. CCC can also be defined as number of days where the cash is held up in the operations of a business. Some products have a longer conversion period and consequently a longer operating cycle. Longer CCC means more working capital is required for business. Shorter CCC means less working capital is required for business. The CCC for a trading operation is different from that of a manufacturing unit. Gross working capital is the sum total of all current assets. Net working capital is the total of current assets adjusted against current liabilities.